Hey everyone, I'm Theo, also known as Tao Cruz, on the CryptoTraders Discord, and today we'll be doing a lesson on how to use stop losses. So we briefly touched on stop orders in the previous lesson, but just to give a little bit more color to that, a stop loss order is a risk management tool they're going to use to limit potential losses. So it automatically triggers a market order to sell security, when its price falls to a certain level. While it can be beneficial, they're also not suitable for every situation. So in a very simple example we have right here in front of us, you can see that we have the entry right here. There's a little bit of an upswing. And we'll assume that right here there's the big downswing. Perhaps there was a earnings event right there, and it didn't quite meet the market's expectations. And we've set a stop loss right here, kind of a good resistance level. And as it turns out, thankfully we did, because we would have incurred even greater losses, probably lost even twice as much more in this example. And this is really indicative of trading in general right here. When something hits your stop loss and you're trading, especially on margin, you should stop out and reevaluate the trade and take a step back. You're gonna stay in there, rationalize, and just say, hey, I'm just gonna buck it out. It's gonna bounce back. A lot of times what happens is you just incur more losses like this, and the lack of discipline really ends up burning you harder at the end of the day. So we'll start here with when to use a stop loss. First and foremost, we're going to be using it to manage risk. So we use it to limit potential losses and protect our capital. So setting a stop loss is going to ensure that we exit a trade if the price moves against our position and beyond a certain point. So it would prevent significant losses and potentially even a liquidation if you're trading on margin. Secondly is emotional control. A stop loss order really enforces discipline by sticking to that predetermined strategy. And it helps you adhere to the trading plan and just avoid impulsive decisions, revenge trading that most of the time are going to incur more losses. Thirdly is time management. So the great thing about setting a stop loss is if you can't be around the market at a certain time, like say it's you're going to bed for the night, and you're doing well in position, you still want to keep holding it, and you want to swing it overnight. You set a stop loss there, that's going to protect you. If there's a big move against your position, whether you're long or short, the stop loss you set is going to prevent you from getting liquidated and obviously incurring significant losses. And lastly, I think a stop loss is best used with short-term investments. And when I say stop loss, I mean like a stop set in the market. So generally speaking, you're going to want to use technicals when you're setting the stop losses. So kind of looking at the support resistance, looking at the relative strength indicator, RSI. Also, your moving average, convergence, divergence, your MACD. And these technical indicators I'm going to do a video on in the near future. So now we'll move on to when not to use a stop loss. So you don't want to use a stop loss on a token that has low liquidity, because that implies there's low volume on it, and your stop loss could be triggered by the wide bid-ask spread, as there's few buyers and sellers at any given price. Secondly is an event. Obviously for equities there's earnings announcements, but for the crypto side and tokens there's kind of like big news events. If there's a big upcoming event, like say like having like a Bitcoin, perhaps instead of having a hard stop loss set in the market, use a mental stop loss. Typically with these big events, there's going to be a lot of volatility associated with it, and you don't want to be prematurely whipsawed out of your position due to that. Thirdly, you really want to account for tight ranges when you're setting stop loss in the average price volatility. Say if a token does have higher volatility, maybe give yourself a little bit more liberty on that stop loss. Just in case it does kind of knife down just a little bit beneath that support, you don't get kind of whipsawed out there. And lastly, I think when you're to have a long-term investment, you want to lean more towards a fundamental analysis of the token, and thereby I think that you kind of want to use a mental stop. Say there's a specific price for a token where if it trades under and closes under for like say like a day or like a week time frame, that you're just going to cut your losses right there and then. I think that's a better way to play it for a long-term investment, where you're probably going to be using spot or low leverage, and that as opposed, to say like a short-term investment where perhaps you're using high leverage and your time frame's a lot shorter. And you definitely want to protect yourself on those short-term investments with a hard stop set in the market. Versus just having like a mental one where you'll have like an alert that'll pop up and tell you it's past its price level, and then it's up to you to go in and have the discipline to close your trade right there, even though it might be for a loss. And we'll finish up here with some tips for using stop losses. So firstly, you're going to want to periodically adjust your stop losses. And for example, say if you're doing a long position and you've hit 2 of your price targets, I would say you would definitely want to move your stop loss up probably to entry or maybe even up to your first price target, just to protect the gains that you've had on that trade. Secondly, I've mentioned this in this lesson, is to use mental stops. So that's going to help you avoid getting whipsawed out. Should there be like a token with higher volatility, having that mental stop and not having a hard one kind of set in the market, is going to prevent you from kind of getting locking in the losses there when the volatility is highest. And then say it goes back to the average, the mean where it was before. That could just kind of put you in a rough position where your thesis is still valid, but yet like you've kind of already locked in losses on that trade, and then have to make a choice on whether you're going to buy back in there, or pass and go on to the next. And lastly, and probably most importantly, is you use low leverage. You can be a lot more liberal with your stop losses when you're using low leverage. If the price moves adversely against you, that the probability of you being liquidated is much lower, and that just gives you a peace of mind, and it lowers your risk overall. Most of the trades you should be doing, I think should probably be around probably 3x to 5x, like max. Maybe if there's a killer scalping opportunity you want to take, maybe you do like 10x, but anything more than that it was really risky, especially for someone who's just starting trading. So I would just take that into consideration and be wary of the amount of leverage that you're using, and also the liquidation prices on any of your trades.